This is a video about accounting.
Thanks, kiddo. Hi, everybody. Welcome to this video about inventory cost formulas. By the end of this video, you should be able to identify and describe various cost formulas, specifically specific identification, weighted average, and first in, first out. You should also be able to calculate COGS and ending inventory using those different cost formulas. Before we get into this too far, I want to make sure we're all on the same page when it comes to the importance of companies accurately reporting the value of their inventories. First, we know on the balance sheet that inventory is one of the largest current assets a company carries. So the value that the company assigns to its ending inventory when the reporting period is over has a direct and significant effect on its balance sheet. And that's a big deal. Second, we know that when a company sells something to its customers, they need to calculate the cost of goods sold. That cost of goods sold can be one of the most, if not the most, significant expense on the income statement. We also know that revenues minus expenses equals profits. So accurately calculating COGS has a direct effect on the company's bottom line, which is a major concern for management, shareholders, potential investors, and creditors. So also a big deal. Companies need cost formulas to calculate the value of their COGS and ending inventory because the prices they pay to acquire or manufacture inventory change over time. Sometimes they fluctuate up and down, but more often than not, they rise over time. When a company sells inventory, they need to figure out how much that inventory was worth so that they can accurately report COGS and their inventory balance at the end of the year. Companies can choose what method they will use to calculate those values, and those methods are called cost formulas. They use those and then identify them specifically in the notes section of their financial statements. Now let's look at their options. There are three main cost formulas to choose from: specific identification, first in, first out, and weighted average. We're going to look at each one in turn. The first one is specific identification. Personally, I think that this is the most straightforward of the three. The formula is used when a company can easily track the cost of each individual piece of inventory. These are companies that usually manage a small quantity of high-priced, unique items. The important words there are small quantity and unique. Two examples of such companies would be a commercial art gallery and a car dealership. At the art gallery, each piece of art is unique and easily distinguished from the other pieces. The gallery is not storing, showcasing, or selling thousands or even hundreds of pieces of art. Their inventory is small, and each item is unique. Because those are the characteristics of their inventory, they can identify the value of each specific piece for the balance sheet, or for COGS when they sell it. The same is true for car dealerships. While many of the cars may look the same, they all have different combinations of features. That could be colors, special interiors, even different security and safety features. Also, each car has its own vehicle identification number, or VIN. You can find that inside the windshield on the driver's side. All of these characteristics taken together make the cars different enough from each other that their costs can be tracked individually using the specific identification formula. So let's look at an example with Abiento's art gallery. On April 12th, Abiento's art gallery purchases a painting for $12,000. On April 15th, Abiento purchases a sculpture for $7,000. On April 20th, she purchases another painting, this one for $18,000. Also on April 20th, a customer comes in and purchases the sculpture for $10,000. On April 25th, Abiento Art Gallery purchases a second sculpture, this one for $15,000. And on April 29th, one customer purchases the first painting for $20,000, and a second customer purchases the remaining sculpture for $25,000. To calculate the gallery's COGS and ending inventory for April, we can track the specific costs associated with each artwork. We know the costs of each of the items that were sold that month. I've noted them here with the red lines. When we add those up, we get a total of $34,000. We can also figure out the value of the ending inventory based on what the gallery still has in stock. In this case, it's just the $18,000 painting. And that's it. As I said, it's pretty straightforward. But that's because we're dealing with inventory that is small in number, and each piece of inventory is unique. Now it's your turn. Please pause the video and give this problem a try. Calculate the company's COGS and ending inventory for the month. Here are the transactions and the dates and the values. Pay attention to which transactions are purchases and which ones are sales. Welcome back. Let's have a look at the solution. To calculate COGS, the accountant counts the cost of the inventory that was sold during the period. So that was 2 Mini Coopers at $30,000 each, and the Mustang for a total of $145,000. For ending inventory, the accountant just counts the value of the inventory that's left over at the end of the month. And in this case, those vehicles add up to $118,000. And there's the solution. I hope that worked out for you. We now know that we need to use specific identification when the inventory is unique or not what's called interchangeable. If your inventory is not unique, it's considered interchangeable. An example would be gasoline. In the underground tanks, there's no way to distinguish between gasoline bought by the gas station at the beginning of the week and gasoline bought at the end of the week. It's all interchangeable. And when your inventory is interchangeable, you do not use the specific identification cost formula. You use one of first in, first out, which is shortened to the name FIFO, or weighted average. Let's have a look at FIFO first. When a company that chooses to use FIFO as its cost formula is trying to determine COGS, the values of the first inventory purchased are assigned to the first inventory sold. I'm going to say that again. The values of the first inventory purchased are assigned to the first inventory sold. The thing here is our focus is not on the products themselves, but it's on the values of those products. I like to think about a hardware store example, and you can see it here. At the hardware store, you can find a bin of nails. None of the nails has a barcode on it. When the number of nails in the bin gets low, an employee fills the bin. Remember near the beginning of this video when I said that the cost of acquiring inventory changes over time? Well, it's possible that the cost of the nails that have been added to the bin are different than the cost of the nails that were already in there. So there's no simple cost-efficient way to measure the cost of each individual nail when the purchase price changes over time. So let's imagine a sequence of purchases and sales happen at Haggart's Hardware. Okay, I'm going to draw a bin here, and that's going to be where we store the value for this example. On May 1st, Haggart's Hardware purchases 1,000 nails at 25 cents a pop. So the accountant is going to take that value and put it in the bottom of the bin. Then, on May 15th, the hardware store learns that the cost of nails is going up. So they buy 1,000 more, this time at 30 cents each, and that value goes into the bin on top of the previous value. Lastly, on May 30th, Haggart's Hardware buys another 750 nails, this time at 35 cents a pop. Again, that value goes into the space along with the others. Remember that the physical nails are all jumbled up now, but the FIFO cost formula keeps their values separated to help calculate COGS. Now let's see what happens with our first sale. On May 31st, the hardware store sells 1,100 nails to customers. So the accountant takes the value of the first 1,100 nails that Haggart's Hardware bought and assigns it to the nails that were sold. So to get those 1,100 nails, we take out the 1,000 from the first purchase. There are still 100 more nails to add though. So the accountant is going to take 100 nails from the next purchase, which was at 30 cents. From this, we can calculate both Haggart Hardware's COGS and ending inventory. Now, I use this visual representation to demonstrate the concept. I wouldn't use this to do actual calculations. In fact, I've created a handy little table here to help us with those calculations. If you'd like a copy of your own, you can click on the link in the description to open a template and you can download it yourself. So let's track those purchases and sales at Haggart's Hardware. First, the purchases. We have the May 1st purchase of 1,000 nails at 25 cents a pop. So the cost of that bunch of nails is $250. Then we have the May 15th purchase, which is another 1,000 nails, equaling $300. And on May 30th, the $750 purchase at 35 cents each, which works out to a less round number, $262. So we're left with a total number of units, and the total cost for all of these units is $812.50. On May 31st, the hardware store sold some nails to customers and charged them 35 cents a nail. So I moved to step 2 to track the sales revenue, which equals $385. From here, the company uses FIFO to assign value to the 1,100 nails that have been sold to figure out the cost of goods sold. They also use the FIFO cost formula to assign value to the remaining nails, and that will give them a value for ending inventory. So now that we've tracked the purchases and the sale, let's go ahead and calculate COGS and ending inventory using FIFO. Okay, so to figure out the COGS for the 1,100 units that were sold, we start assigning value from the first acquisition or purchase, which was the 1,000 nails at 25 cents each. That doesn't get us all the way to our total, so we need to start taking value from the next batch, which gives us another $30 in value. Now we're at our total. We don't need any of this value. We total up our costs per bunch, and we discover that our COGS was $280. For ending inventory, we sort of just pick up where we left off. We used up all 1,000 of those in our count, so we can't use any more of those. There are 900 nails left from the May 15th purchase, which gives us $270. And all 750 of the May 30th purchase are there. And so we have 1,650 nails left for a total of $532.50. So that's how we use the FIFO cost formula to calculate these values, which means it's now your turn. Please pause the video and give this problem a try. Remember, you can go back and watch the process again for the hardware store, but I'd like you to use the FIFO cost formula to calculate Crocker Computer's COGS and ending inventory for the month of June. Welcome back. I hope that wasn't too complicated a process for you. Let's have a look at the solution. To calculate COGS, we have to get to 400 units. So we start with that June 1st bunch. We need to use all of them to get to 400. We need to use all of the second purchase to get to 400. And then we only need 50 of the 75 that were bought on June 29th. And that gives us our total COGS of 4,700. That remaining 25 is what we see in our ending inventory, each valued at $16, for a total ending inventory value of $400. I hope that went smoothly for you and you arrived at hopefully these same answers or at least something close. If you didn't, please go back, check your work, see where you went wrong, and hopefully you can make the corrections you need to make. Well, you're doing well. We're at weighted average. I know this is a lengthier video than usual. If you like, you can pause the video, take a break, and come back to it later. But we are almost there. This is the last one, and it's called weighted average. Unlike FIFO, where the values are kept separate, weighted average combines the different purchase prices and the number of inventory units to generate an average value for each piece of inventory. It does this calculation at the end of a reporting period. If we go back to our hardware store example, rather than recording the values and sequences of purchases separately, the values, like the physical nails themselves, get mixed together. Let's return to Haggart's Hardware to purchase and sell those nails all over again. This time though, we're going to use the weighted average cost formula. So here's my bin of value, and here are our purchases. So the May 1st purchase of 1,000 gets put into this space. And I take the value of that second purchase and I put it in the same place as the value from that original purchase. Then I take the value of those last 750 nails and I put them in here too, and just mix those values up. Those values are all jumbled up now, and we'll use the weighted average of each unit to help us calculate cost of goods sold. And here's our first sale. May 31st, 1,100 units at 35 cents each. To calculate the cost of goods sold, I now figure out the average value of each of these nails and multiply it by the number of units sold, and that will give me COGS. I can also use that same average to figure out what the ending inventory is. So let's do another example, and we're going to use another table. And again, you can click on the link below in the description to open your own copy of the template. On May 1st, the store purchases 1,000 nails at 25 cents. We know that this is 2,500. We also know the values of these other purchases from our previous calculations for FIFO. We recognize this number, and we also remember that this number is $812.50. The wrinkle now for us with weighted average is we take this total cost and divide it by the number of units. And that actually gives us a value of 29.5 cents per nail. On May 31st, the hardware store sells 1,100 nails at 35 cents a pop to generate $385 in revenue. Now we're ready to move on to the cost of goods sold and ending inventory. So the total number of units sold that month were 1,100. It's made up of this one line of sales. 1,100 nails at 29.5 cents each gives us a total cost of goods sold of $324.50. The ending inventory is all of the remaining nails, so those 1,650 that we had multiplied by 29.5 cents gives us $486.75, and that's our ending inventory value. Hopefully that made sense. It's a little quicker than FIFO. Hopefully it seems simpler because we're dealing with averages. And now it's your turn. For the last time, please pause the video and give this problem a try. Remember, you can go back and watch the process again. Using the weighted average cost formula, calculate Crocker Computer's COGS and ending inventory for the month of June. All right, one more time. Here's the solution. Nice and simple. The average cost per unit is $12. They sold a total of 400 units. 400 at $12 a pop is $4,800 is our COGS. To calculate ending inventory, we take those 25 leftover units, we multiply them by the average cost of $12, and that gives us a $300 ending inventory value. We can see from this table that choosing one cost formula instead of another, when our inventory is interchangeable, has an effect on both the income statement and the balance sheet. When the inventory costs rise over time, for companies that use FIFO, COGS is lower, which results in a higher net income. FIFO also leaves the company with a higher ending inventory value. For companies using weighted average, they have a higher cost of goods sold, which results in a lower net income, and they also end up with a lower ending inventory value. So the question is, how does a company choose? Well, earlier I said that companies with inventory that is unique and in small quantities use the specific identification cost formula. So that's an easy one. If your inventory is interchangeable, though, you have a tougher decision: FIFO or weighted average. To figure that out, companies ask themselves a few questions. First, how does this inventory move through my company? Does it move in bulk, mixed together, like our gasoline example from earlier? If so, then weighted average would be the most accurate representation of the flow of inventory. Or maybe your inventory flows in a way that is similar to grocery stores, which is smaller batches in chronological order. If that's the case, then FIFO would be the most accurate representation of your inventory flow. Another question to ask is, what is your company's primary consideration? If the priority is to maximize your profits, then FIFO is definitely your choice. It increases your net income by lowering your COGS and therefore gives you higher profits. But if your primary consideration is to minimize tax dollars, then weighted average is the way you'd want to go. It distributes the overall cost of your inventory across all units, and that increases your cost of goods sold, which has the effect of lowering your net income. And I just want to add one more note, so you don't leave with the impression that you can just switch cost formulas whenever you like to suit your company's need from year to year. You can't do that. If a company changes inventory policy every year, that would look suspicious to everybody, from government to investors to even your employees. Also, when a company changes its cost formula, it actually has to reissue previous financial statements applying the new cost formula to that old data. It's really a pain, an expensive and time-consuming pain. And there you have it. I know this was a long one, but you made it. Way to go. We had to take some extra time to demonstrate the calculations, and I think it's helpful to do the calculations here in the video because they are the application of the FIFO and weighted average concepts. I hope that you found this information clear. To go on to the other inventory videos, there's one about inventory basics and one about inventory valuation and performance ratios. You can click the links here. If that's all the inventory you can handle for now, you can find the videos on my channel later. Till then, thank you very much. I'll see you next time.
Thanks for watching this video made by my dad.